All right, it looks like it's time to get started. It's about 8:30 now. Thanks very much for everybody who joined the call so far. Got a nice group of people. We'll be sharing about an hour together. I'm going to go ahead and mute everyone now to make it easier and cut down some of that background noise. Um, Also, if you have any questions during this webinar, please feel free to shoot them over to us using the chat feature at the bottom of your toolbar. And our goal is to spend this hour sharing practical information to help you manage your business and its finances through these tough times. Obviously, we're all in this together. Our expectation is we'll be able to share some information that you'll be able to use to help survive this tough time. So from an agenda standpoint, we're going to jump in with, what is scenario planning and why is it important? We're going to talk about how to approach that, how we can gather the information and organize it at pace and with some velocity so that you can make decisions quickly. And lastly, we're going to talk about strategic prioritization, how we can actionalize that information that we've learned and put things in place to make sure that your team is getting done the things that need to get done. So by way of introductions, ClearPath Business Advisors is who Chris and I both work for. And ClearPath has been around for about 20 years, a little over 20 years now. And we've been advising business owners under the premise that owners should create a healthy, sellable business, whether they plan to sell or not. And we've got expertise in strategic, financial, operational leadership and coaching, M&A advisory services, organizational health. We do recruiting and outplacement services and also strategic planning. So my name's Dan Mickey. I'm the organizational health practice leader. I lead typically strategic planning projects, as well as anything having to do with organizational health at your companies. And next, I'd like to introduce Chris Crawford. He's our CEO, and he'll take it from here.
Hi, my name is Chris Crawford, and I wanted to share a bit more about my background to set the stage for you. At my core, I am a strategic thinking CFO with a couple of twists thrown in. I have a lot of M&A experience, almost 200 buy-sale transactions, a law license, and a CPA, both licenses and active. I grew up in an environment where understanding how to forecast your business in a real-time manner was critically important. To be able to do it in a few hours, updating a forecast, shows that you really understand the drivers of your business in a nice, concise way. We are trying to bring that sort of thinking to you today. So this is a how-to webinar. It's not a discussion of topics in some kind of a general way. It's certainly not an all-around discussion of all things COVID-19. For example, we're not going to get into the federal loan programs and the payroll protection programs. We're not going to even talk about any of that. What we're going to do, though, is we're going to help show you how to develop and implement a scenario planning process now. We're going to show you how to build the spreadsheets. And we want to help you do this if you need our help. But first and foremost, we want to show you how to do it yourself. I'm going to throw a lot of spreadsheets at you. And it can appear complicated, but it isn't as hard as it looks, and it's real, and you can do it. We'll make the PowerPoint available to you, anybody who asks for it. And if you want our help, we'll absolutely want to give it to you. This is what we do at ClearPath. And I know, having been a CFO myself, I know that there's a certain mindset in the accounting area of the company, a very detailed mindset. When I was a CFO, I had a very strong controller. She couldn't leave a spreadsheet if everything didn't balance to the penny. And it's, for some people, that would drive them crazy. But you need to have that level of accuracy underneath so that the CFO and the CEO can get a concise set of data points to make decisions from, and they're reliable. So there is a little bit of detail underneath. It's not overwhelming, but at the top, there will be a nice summary page for you and for your CEOs to help make decisions from. Fundamentally, right now, we're not in a wait-and-see environment anymore, as we all know, as we've all felt. Just in the past few weeks, we've all been through a lot. CEOs, business owners, business leaders, they're trying to find their footing. At first, it was like frozen in space. People were not moving. They were waiting to see what would happen, trying to get their footing. Now it's time to move. And so we want to prepare scenario planning now so that you know what to do when those scenarios become real. We've been through it, and we want you to go through this process so you know what to do. And as Dan said, please ask questions so that we can help you even more. So what is scenario planning? At its core, it's real-time forecasting. It's something you can do in hours, not days, not weeks, hours. It focuses on the things that matter most, the key drivers. Using the 80-20 rule, you're going to hear me say that 10 times today. So it's a high-level view, but beneath the surface, as I mentioned, it's very granular in structure. It integrates cash flow forecasting and business forecasting into one. So you got P&L concepts, balance sheet concept, and cash. I'm not trying to make you into an accountant. I don't want to scare half the people away right off the bat, but there are some concepts that you need to understand. We suggest that when it's all said and done, we're going to build out 3 scenarios. We suggest at least 3 for you under separately defined assumptions, projecting different possible futures, and that you update them constantly. These scenarios will provide revenue streams by customer, channel, product category, whatever makes the most sense to you, and translates any assumed revenue decline into its impact to cash flow. And the other end of this is really important, because what scenario planning does is it creates greater certainty in a very uncertain environment like today. We know the stress, we felt it, most of you are feeling it, your teams are feeling it. It's just pervasive. And going through the scenario planning process removes that stress, and it removes the confusion around what to do. It creates a clearly defined path, ClearPath, just a slight pun there, to help you make decisions so that you need to make regarding cash, labor costs, whether you need to contemplate layoffs or salary cuts, and when things start to turn, when it's time to implement growth strategies. It gives you a platform for identifying strategic priorities and taking action on them now. This slide is just intended to show you a basic difference between normal budgeting, kind of forecasting process, which is on the left, versus on the right, scenario planning, which is essentially multiple scenarios mapped out to create a variety of future outcomes. Do not look at the slide. This is just to make a point. It's not as complicated as some people make it out to be. So don't let anyone talk you into making it complicated. If it's too complicated, you won't use it. You won't be able to update it. So let's quickly move past that to the next slide. Now, even this one, I don't really want you to look at right now, but this is literally a one-page strategic planning or scenario planning dashboard. It's one page. Everything you would need as a CFO or a CEO is captured here. Underneath it, there's a lot of detail. Every colored row has depth, but at its core, this high-level view is what we're after and what we need to have. All right, so how do we get there? So real-time forecasting, something you can do really fast. It's based on understanding cash flow, historical cash flow. That's what we're going to start doing, and then extrapolating that into the future. You have to understand the correlation between revenue and costs. So if you're a products company, you got to include the impact of inventory. If you're a services company, it's more straightforward. It's just labor. Then we run scenarios. We update it on a real-time basis. Then we allow ourselves to look at what we're seeing and strategically prioritize the actions we need to take now. And one of the biggest differences is we're all facing, and what we intend with this webinar is to allow you to make decisions on a weekly basis. This isn't a quarterly or annual strategic planning process. This is real time right now. So if you need to do a hiring freeze, if you need to defer operating expenses, if you need to freeze some spending altogether, if you need to stop, if you need to extend your payables, if you need to cut wages, have layoffs, cut your own pay, all the things that might weave into its solving the scenario that we're defining, you have to consider all those factors. So this is what a cash flow model looks like. It says cash flow forecasting, but it really should say historical and cash flow forecasting. This is a summary view. So this is taking that slide you saw a little bit earlier and showing you a little bit more depth. It captures all your incoming and outgoing cash flows. Beneath the summary, each colored row, all the detail is there you need to make this thing work. The hardest part is building this piece. This could take 10 to 20 hours. Once it's built, it takes 30 minutes a week to update it. We've implemented this in a number of client situations, and 30 minutes is a real number. You need history in the background to allow you to look forward and understand and see what your trends are. A lot of businesses, you're used to hearing trailing 12 months, trailing 3 months. We're talking trailing 4 weeks now. Once it's done, though, it creates the platform to build the forecast going forward. It allows you to anticipate what's happening before it happens and pull the trigger on decisions so you can make them more quickly and more reliably. Just as an example, we introduced this model to a client of ours. We finished it in early December, and within the day we showed it to them. We knew, and they knew immediately, that they were going to run out of cash in February. So in less than 3 months, they were going to run out of cash. They would be tapped out on their line of credit and they'd be out of cash. Knowing that, seeing that so clearly, literally in the day we presented it to them, they took action. So instead of paying $75,000 in Christmas bonuses, they realized, painful as it was, they couldn't afford to do it. This is a $12 million business. And today, right now, they're in so much stronger of a position. They've already gone through their slow season. They operate this cash flow model on their own, updating it 30 minutes a week. These are not experts in GAAP accounting. They truly don't even understand GAAP accounting. They're managing their cash flow with this model. In other words, you can do it too. All right. I don't know why I like this slide, but I do. It's just, if my kids saw it, they would totally laugh. So we're going to shift into how to actually build the models now. So if you hang in there less than 10 minutes, you're going to get it. It's a little bit spreadsheet heavy, so just try and hang in there. So again, this is, all right, we have a slightly different slide. Hang on, okay. So this is incoming cash, and it's historical at first. So now we're expanding those layers. Remember, at the beginning, everything was collapsed, and I said underneath those colored bars, there's a bunch of detail. And that's what you're starting to see. So with incoming cash, revenue, you're going to define the category of revenue by what makes the most sense to you. So it's either going to be major customer, sales channel, product category, whatever makes the most sense to you. Remember the 80-20 rule. So we're only going to list the top few, and then we're going to summarize all the rest and call it all other, so that we can have fewer variables to look at. I guarantee you, when you do it this way, the all other category has its own predictability. You're going to get what you need out of the top few. There's a difference when you're talking about incoming cash. There's a big difference between sales and collections. So we have to allow for the payment terms of your customers and how their history of paying their bills on time to you, and what's changing. Right now, there certainly are stresses on all your customers, so they may be slowing down their payments to you. Then there are other sources of cash, which if we expanded that line, it would show bank loans, owner infusions, whatever else there is. This one, again, this is historical as opposed to forecast at the moment. Now we're breaking out the cost of goods portion of outgoing cash. We've already covered the incoming cash. That's a simple part of this process. The outgoing gets a little more complicated, so we have a few pages of that. We have to break the detail of each cost category into enough granularity so that you can influence changing it in the future. So we got to capture some history. We've shown what might look like for your company. This is an example, obviously. If you're a products company, you're going to see materials, parts, direct labor, transportation, services. It'll be typically direct labor, maybe subcontracted labor. So these are all the cost categories that go into cost of goods sold. And for those non-accountants, cost of goods sold are really those elements of cost that go directly to the revenue. They don't necessarily disappear if the revenue disappears, but they're totally connected to the revenue, as opposed to what's coming next will be operating expenses. And again, remember 80-20 rule. So we're only capturing the key elements of each category. Ideally, the cost categories and cost of goods sold will flow and be connected to and maybe even match the revenue categories, the incoming cash from customers. That would be the case if you were tracking your revenue by product category, then you could track cost of goods by product category. Service companies, you could track by service category and direct labor. Whatever makes the most sense, but we can make it work in any form that makes sense to you. This next category is operating expenses. So again, we're trying to split out the category in more detail so that we can see the historical view, and then later we'll leverage that history and those trends to forecast forward. So in this case, the first category of operating expense, and these are costs outside of cost of goods sold. So here we have payroll and benefits. You might have, certainly, very likely have labor cost in cost of goods sold, as we showed earlier. That's direct labor associated with building or selling or building out products or delivering services. Now here it's other payroll. And we break it out in this case by category. You can see different categories here. You could, if you had a small enough company, you could literally do it by person. You want to do it, again, with enough detail that you can implement or change. You can forecast a different scenario going forward by applying percentages or adjustments to the history. Then below the actual payroll dollars itself, you look at other people costs like benefits, payroll taxes, et cetera, because they're all going to be connected. Ultimately, if we change an element of one of these lines, it's going to ripple through and change the other related costs of payroll. All right, next one is operating expenses below payroll. So we always want to isolate payroll because it's so significant and because it's something, unfortunately or otherwise, we have to be able to implement change, sometimes very quickly and very specifically. Other cost categories in operating expenses, like the ones listed here, may have some variability to them. They may be essentially fixed costs. So we want to list the top tier categories. Again, 80-20 rule, just the most significant items on a weekly basis. And how you capture all the weekly data is through your check registers. It's actually pretty simple. Check registers and bank statements. If you're on an accounting system that tracks it like that, it's even easier. Put these categories down and then lump everything that's not as individually significant into all other. And then below that in the green section, we have the costs, the outgoing cash related to financing the business and owner distributions. So bank loans, credit card payments, dividends and owner distributions, anything like that. And that takes you all the way to the bottom. And now what you've basically done is you've created a historical cash flow basis P&L with the addition at the bottom of the things that come from the balance sheet. So loan payments and owner distributions as examples. Then moving forward, we're going to take the historical cash flow and extend it into the future. The normal trend, what you're normally seeing now, is what we're going to call scenario one. That's steady as it goes. Whatever we're experiencing now, for many of us, we've already seen the drop. If you haven't seen the drop yet, or if it's changing so fast, we'll start with scenario one, and then we'll move quickly into scenarios 2 and 3. The next most challenging aspect of forecasting is identifying the cost and effect between revenue and cost of goods sold, those costs that relate to the revenue. We also, particularly for a products company, but certainly service companies have some elements of this, receivables and payables, but then inventory for a products company, because you may be buying product, sitting on it and not selling it right away. So if the revenue drops, you're still going to have to deal with what inventory do I have, what inventory did I already commit to buy? And we can address all that through this process. And when you think about forecasting cash flow, incoming cash, the easiest and most reliable source for incoming cash in the next near term is obviously your receivables, and mapping that out over allowing for payment terms and customer history of paying on time, and allowing for maybe it's changing right now. We'll use your AR aging, and then after that, it's obviously more speculative. So how do we define the correlation between sales and cost of goods sold and other expenses? Certainly connecting cost of goods sold and operating assumptions to revenue on a formulaic basis would be ideal. And sometimes we can do that, where it just automatically, you create a formula that if you change revenue dollars, those costs change automatically. Oftentimes it's not actually that easy. We want to separately break out purchases and inventory implications, as I mentioned, and we got to consider product lead times. We want to break out labor, cost of goods sold labor and operating expense labor, as you've seen, as detailed as we can to make it make sense. In a service business, for example, labor isn't automatically going to go away. Labor that cost of goods sold labor isn't going to automatically go away just because revenue drops. You have to force the change. You have to force a cut or a reduction. Product business, more complex because you have to purchase product. You may modify that product to add value add components. Direct labor has to be woven in. Then you likely have other labor to process or convert the product into sellable form. So we have to allow for all those pieces. You may have to add other significant costs like shipping. So you have to deal with inventory and parts. So definitely more complicated, but not unsolvable. Those are all very doable things. We will use the 80-20 rule. We'll make it simple as possible. We'll use formulas. It can be done. We've done it with the clients, and we can help you do it if you need our help. The key is to identify and define the correlation between revenue and those costs and expenses. It's kind of like a form of variable and fixed costs. As mentioned, sometimes direct costs are automatically linked, like sales commissions will not occur if the sales drop, and other costs, they're related, but you have to force the change, like people costs, inventory. Another thing that is a challenge about forecasting, people say it's impossible to forecast sales. I guarantee you'll hear that. If you haven't heard it already, you might have said it yourself. You'll say we can't forecast sales. Our customers don't give us a forecast. Well, that's actually not an excuse we can live with right now. We're going to do it. We have to do it. We're just going to do our best. And then as reality unfolds, we'll learn how to do it better, and we'll course correct and make changes. But we can do it. We can start with trends. We can start with what we know and modify it as reality unfolds. And one of the keys about doing it this way, or moving forward into forecasting, is making it interactive. You need to include those people in the organization that know the most about what drives demand and how to deliver our products and services. So you have to include people from sales and operations. This is not a process. Scenario planning is not a process done solely by the financial team. Certainly they need to be involved, but the sales and operations people need to have input. It needs to be interactive. And as mentioned, sales do not equal collections, so we have to separately assign assumptions related to how we're going to collect the cash for revenue that occurs. And just like any forecast, it's going to be wrong, and we'll learn, and it'll get better. But that's what the scenario planning process will actually help us do. Always remember the 80-20 rule. All right. So now let's build out scenarios. So we're going to walk through a few slides on that. So again, this is a summary. This is going to look familiar, but now instead of seeing a bunch of history, we're seeing projection. The light green projection columns are a natural extension of what we've already seen. So that's just using your trends and what you know from history and modified for what's happening now. Putting that together is, now that we're at this stage of the game, we're almost done actually, because this part of the process happens pretty quickly. Once it's set up, you can update it and modify it literally in hours. So getting to this point is the key. That's the hardest part. At this point, we've already identified all the categories of incoming and outgoing cash flow. We understand the correlation between revenue and costs. The historical view helps build out this natural trend going forward. And again, that's going to be our scenario 1. Then to build scenarios 2 and 3 and beyond, we simply get into the level of detail that we need in each bucket to alter the assumptions related to the incoming and outgoing cash. Costs that are connected to revenue will automatically change. Costs that are not directly connected but are related to revenue will have to force the change, and then other overhead costs will have to force the change to get to an end result that we want. So here we have 3 scenarios. We're going to show you how to build this. We're doing a real example of scenario planning. This is, again, the summary view. All the detail in those colored bars are right below. Click away. So the key element at this point is to identify what you're solving for. So you might be solving for break even. You might be solving for, you know what, I got money in the bank, I have a line of credit, I just need to get to October when I'm on the other side of this thing and there's some event that I believe will bring an infusion of cash. Or you might say, I need to get through a season. I just got to get through the season, whatever it is. But let's say for our example, our target, our solve, the thing we're trying to solve for is break even. Let's say we're already tapped out on our credit line. We're minimal cash in the bank. We want to just get through this and every month be break even. So we create 3 scenarios for incoming cash, kind of a low, medium, high, a standard thing, to allow you to make sure you're prepared and can be proactive no matter which scenario turns out to be the most true to achieve the thing you want, in our case, break even. We're going to evaluate and define cost of goods sold and operating expenses and the changes necessary for each scenario, either formulaically where we can or by forcing change where we can't, to again solve for our break even. We're going to have to deal with our biggest costs, material purchases and labor. Those are going to get the most attention for sure. And then we'll move forward. I'll just give you a quick example. When this whole crazy quarantine started, we worked with the client and had created scenario planning. And on Monday, we went over the scenarios. And on Tuesday night, we were already through scenario 1 and into scenario 2. So it's 48 hours later. Scenario 1 was out the window. Scenario 2 was what we were living with. We had already defined what needed to happen. The client was able to make those changes instantaneously. They didn't have to think about it. I mean, yeah, it's stressful, it's painful, but they knew what to do. And that's the critical element of what we're trying to accomplish here. All right, so to build out the scenarios, this first scenario is incoming cash. So as an example, again, solving for break even, we're going to assume scenario 1 is the current trend. Scenario 2, we're saying revenue's down 20%. Scenario 3, revenue's down 40%. In this case, we're showing it forecast by customer. Again, you can forecast it by channel, product, what makes the most sense to you. Cash from sales has to be collected. So we assumed that for every sales, the cash collection would be lower, and in this case, unusually low compared to historical trends. We can alter that. It's very easy, all percentages. And then we include other sources of cash, whether we can borrow on the line of credit or not. So scenario 1, again, current trends. Scenario 2, 20% cut in revenue, half ability still to draw some on our line of credit, but not as much as scenario 1. And then scenario 3, it's a 40% drop in sales and we can't draw on our line of credit at all. Okay? We can make these assumptions whatever we want. Outgoing cash, all right, the first category, again, is the cost of goods sold related items. So product, direct labor, freight, whatever makes the most sense to you. Scenario 1 is the current trend. Again, same logic. Scenario 2, we cut material purchases by 20% and all related costs that go with sales, 20%. Scenario 3, we cut purchases 40%, but we determined that we can't cut our labor 40%. That'll shut us down. So we cut it by 30%. Then we went back to 40% for other cost of goods costs like freight and other. And remember, in our example, we're trying to solve for break even. So I already know, because I have this model in front of me, I already can see the impact of every change I'm making in terms of what does the bottom line look like. And you can play around with that. And then you can make sure you make the changes you need to get to the thing you're trying to solve for, which again is our example, break even. This next one is now payroll below cost of goods sold direct labor. So scenario 1, current trends. Scenario 2, we're going to do a 20% pay cut. And we're going to have some layoffs. Scenario 3, we're doing a 30% cut and having some layoffs. Let's go to the next one. These are the other costs besides payroll that hit operating expenses. A lot of these costs are essentially fixed. So you can't necessarily cut them as easily as you can payroll and purchases. So scenario 1, current trends. Scenario 2, we cut sales commissions in line with sales. So 20%, 40% in scenarios 2 and 3. And then the other costs, we just went through the list and said, where can we actually cut? So insurance, rent, other expenses. And we just threw in some assumptions based on how important, and to be honest, what we needed to get to break even on the bottom. This last category is how we're financing the business. So in this case, paying back our line of credit. Scenario 1, we were scheduled to make a payment of 100 grand. Scenarios 2 and 3, we're not making that payment. Scenario 1, we were scheduled to actually distribute cash to shareholders. Scenario 2, we're not. We're preserving all cash. So we play around with those assumptions, again, trying to get to break even. And now you can see at the bottom, the very bottom, the blue row, you can see scenario 1, we were in the hole 250 grand. Scenario 2, with a 20% drop in sales, we actually make money, 86 grand. And scenario 3, 40% drop in sales, we're hovering right around break even, but we figured out how to do it. And that's the key. So here is the final summary again. The single dashboard, assuming our goal was a solve for break even. Again, in this scenario, what if we're tapped out on our line of credit? What if we have no ability to find other sources of cash? So we chose break even as the thing to solve for. As reality unfolds, we shift to the next scenario where we need to, as mentioned. Sometimes it's super fast, 48 hours. Other times you have a lot more warning, but you've thought it through. And then as reality unfolds, you might create new scenarios, but you'll know what to do to make the hard cuts. The key is you've already thought it through. So you're not thinking in the moment and reacting in that moment. You have to track each scenario. You have to track and update your forecast on a constant basis. It's not something you do once every month. It's something you're kind of always aware of. But you keep it as simple as possible using that 80-20 rule that captures few of the variables. You can have it on one page. You know what to do. You use this information to shift your focus from firefighting and reacting and being stressed out and having stress and just invade your entire company to being more confident, to shifting back to strategic mode so you can set priorities. And now we're going to shift to, well, how do we set priorities for the next week, the next 2 weeks, the next 30, 60, 90 days? So everything's being compressed right now in the environment we're in. And so we have to compress our decision-making process in that time, but we still need good data to do it. And I'll leave you with one thought, because I know all of us have interacted with a lot of CEOs. Many of us are CEOs, and over the years, 20 years for ClearPath, I can't think of a time where I ever heard a CEO say, in hindsight, I should have taken longer to make that decision. It's not the case, and it's certainly not the case now. We need to take action now. We need to be decisive, and we need to base our decisions on as much fact and data as we can so that when we apply our gut feeling, we can do the best job of getting through this and show our team confidence. All right, Next slide. I have a offer for you guys. The first person that chats, it's got to be not an existing client or an employee. The first person that chats what this picture is will get 4 hours of free consulting. And the first client that chats what this is will get a bottle of wine. It'll be a good one. All right, Dan, your turn.
All right. Well, I'm pretty sure that that's the cover of Metallica's best album, but I'm not 100% sure, but I think that's what it is. So
We're the guy on the left. I meant to say that.
the guy that's not on fire. Okay.
Yes,
Perfect.
yes.
All right. So shifting gears a little bit to Chris's point, and I do see some chats coming in, so we'll make sure they're in order. So I'll be able to go back and we'll look at those here in just a few minutes. And again, I probably only have a few minutes worth of stuff to share, and then we're going to get into Q&A. What Chris really alluded to, most of the work that goes into building the scenarios is really directed toward action. So the strategic prioritization part that we're going to share is really the main part of taking the thought and then putting it into motion for your team. And we really do that through 4 things. First, we have to decide what's most important. What are the levers we need to pull? What are the things that we need to do in order to make an impact? The second thing is converting those objectives into OKRs, into objectives and key results. And everybody has their own thoughts and different things about what they call them. And some people call them rocks and some people call them, tasks or whatever. But objectives and key results is the terminology we use, and we'll get into that a little bit. The third piece is once you've decided what's important and you've set those plans up, you've got to communicate that to everybody. Everyone in the team should have awareness of that. And then lastly, perhaps most importantly, is we've got to then hold each other accountable to those results. It doesn't make any sense to do this work and then not hold each other accountable. So as we decide what's most important, typically what is expected, and my guidance for CEOs or business leaders would be, decide what you want the organization to look like. This is kind of alluding to the start with the end in mind scenario. And the objective here would be, we always encourage clients to do long-term strategic planning. And I'll never say that that's not, an important piece to do. However, right now, to Chris's point, we need to be looking out 14, 30, 60, and 90 days. There's a lot happening. Things are changing very, very fast. The stay-at-home orders change, it seems like almost every day. I know we had a significant change yesterday. So as we're thinking about what do we want to come out of this the other end looking like, to Chris's point, if we're solving for break even, great, we can solve for break even. But be specific and set those numbers. And the visual on the right that I set there, most companies choose different numbers, but in this case, I threw a few up there: revenue, gross margin, the number of customers, active customers, what's our employee headcount, and what's the operating income we want. Either in this case, it's for 30 days, but we'd even define a 2-week, a 1 month, a 2 month, and then potentially 3 months, depending on when you see this thing changing. So we need to set those numbers to be specific. And then I think it's really important at this point to ask ourselves, what could go wrong? What changes in the environment? What changes in the marketplace? What legislative changes might happen? And certainly in many cases, we're asking ourselves right now, what could happen relative to the health situation going on in our country and around the world? Once we've identified some of the things that could go wrong, it is important, and we need to know that they're going to happen. But more importantly, what things are under our control? What are the levers that we do have the ability to pull? And because if we only start looking at the external forces we can't control, we'll go crazy. So we need to start looking at those levers we can pull ourselves, and again, put those into categories of 2 weeks, 1 month, 2 months, and 3 months. So effectively what we've done at that first stage is we've said, these are the big, really important things we need to do. We have to strive for break even. Maybe we need to control costs. Perhaps we're going and looking to drive revenue in this case, or maintain revenue. But ultimately, once the company has decided what's most important, we've got to then break those objectives down into tasks, and we call those key results. The mantra, everybody at ClearPath gets sick of me saying this every once in a while, would be, we've got to get clear on who does what by when. If we lose sight of who's doing which tasks and what those due dates are, very few things tend to happen in the right direction. Once we've set the objective, then it comes down to setting those key results and assigning the activities to people. That's where the rubber meets the road. That's where things actually happen. So we've set the objectives. We've decided what those tasks are that we're going to attack. Communicating out to the rest of the company is really important. And what we're aiming for are a couple main things. We want people to align their effort, align their work to those same goals. So if we said we're going to Hold revenue, well, that's a different thing than control cost, which may be a different thing than strive for break even. They can all come together, but we really want to let everyone know in the organization what it is we're aiming for and give them the opportunity to align with those company goals. Sharing the details with everyone is an important conversation. This one comes up, I would say, very often with regard to how much information do we share. Some companies are totally comfortable sharing revenue numbers, and I think that's common. Many organizations aren't comfortable, especially privately held companies, aren't comfortable sharing profitability numbers. And that's okay. Whatever the organization is comfortable sharing, we want to try to push ourselves to share a little bit more, especially in these times, but share that information and share those details with everyone. And again, once you've done that, encourage individuals and departments to set their goals in alignment with the company objectives. Driving accountability, we're going to talk about that last, but driving accountability not just at your leadership team level, but all the way down through the managers and through individual contributors. Driving that accountability is really critical right now when every penny counts. And I fell across this saying a while ago, and it really makes a lot of sense for me, and it really brings home a lot of what I'm trying to say here, is that when we introduce the clarity of this strategy and we introduce the clarity to all of our teammates, that clarity reduces friction. And a lot of times friction shows up in a bunch of weird ways. It may be two managers kind of playing tug of war over a turf war, or people not necessarily agreeing on where to allocate resources. But once we set those company objectives and we drive that clarity, it's going to reduce the friction. The output, the outcome of the reduced friction is super important right now. But the outcome of reduced friction is you'll have faster and better decisions being made by everybody across the company. So clarity reduces friction, which improves speed and quality of decisions. And I really think that's an important one to kind of burn into the back of your brain right now. And I love this quote by Samuel Johnson on the bottom left. People need to be reminded more than they need to be instructed. So again, once you set those company objectives, just keep saying the same thing. Become that chief reminding officer. Let your staff know these are the objectives, and please make sure you're aligned with them. So holding each other accountable is again, I mentioned this before, it's where the rubber meets the road. In these times, especially with all the craziness going on, and particularly because most of us are working virtually, we need to establish meeting rhythms and make every effort to talk more often. We've got to keep those communication lines open, and it's one of those things we have to physically force ourselves to do sometimes, is either pick up the phone, jump on the Zoom call. I know a lot of people are using Microsoft Teams, whatever that tool is. Please make sure that you're staying in contact with your teams. And just as a sample, we recommend the following meeting rhythms. Twice a week, your leadership team should be getting together. Twice a week, you should be having a one-on-one with your supervisor. So if you're the supervisor, you should be giving all of your direct reports a little bit of time. Maybe it's only 15 or 20 minutes, but give them time every week where they know that they're going to get a chance to share their thoughts and concerns and worries or ideas. But make sure you're given at least twice a week that you're finding time to talk to your team. And then we recommend that teams and departments get together twice a week as well. So force that thing to happen. I'm sure we've all seen it, the virtual happy hour and some of these other things. They're great. We do need to stay connected, not only on a work level, but also maintain those relationships. So encourage your teams and departments to meet twice a week, again, virtually at this case. And then certainly with the rate of change and how fast things are going, try very hard to get your whole company together and repeat this messaging and share this messaging once a month. Again, it can be really hard, particularly if you've got, say, manufacturing folks who don't have computers or workstations. Figure out a way. Maybe it's just a phone call, but really try to drive that messaging and remind people that there are a lot of things going the right direction at any given time. And that's that last piece I want to really reemphasize, is celebrate the wins. There's a lot to worry about. There's a lot of hand-wringing going on, but even in tough times, there are good things happening. You know, maybe somebody lands a new client in the middle of this. Maybe somebody figures out a way to shave 5% off a cost structure. You know, maybe somebody figures out a better way to do something or improves a process. You got to give your team the opportunity to celebrate. They really need it, perhaps now more than ever. So just this last slide of mine is, I just want to show you that this is the kind of recommended framework that we are encouraging folks to consider as you go into this really high-paced, fast velocity, looking at numbers, very often, to Chris's point, weekly updates. If you can go 2 weeks, 1 month, 2 months, and 3 months out, set those KPIs, set those numbers. Maybe it's revenue, gross profit, whatever those numbers are, they'll probably be different for you. And then also put those objectives and key results in a place where you can see them. A document like this can be shared really easily with your team. You can convert it into a PDF or email it out, but that's a great document as a way to just keep everything organized in one place. So, and obviously I know there's a bunch of small font there. This will be included in the slides for those of you who want copies of it. So with that, I'm going to unmute Chris as well. And actually, I'm going to unmute everybody. Once I click the unmute button, so you've got an opportunity. There might be a bunch of background noise. So if you're somewhere that's a little bit noisy, feel free to kind of remute yourself. If we have any questions, we'll throw it up. And I'm going to jump into the chat now and see if there are any specific questions. So again, you can either chat them in or just go ahead and ask them right to Chris or myself.
I'll start out with one that came through. So as we go through the coming weeks, do we need to update and maintain all three scenarios or reduce as reality replaces uncertainties? And I see that's the key to this whole thing, is we have to keep this updated on a real-time basis. Reality will be different than any scenario, but each scenario should be closer to reality. So as we get to a version that seems to speak to what we see now, we would tweak and update those assumptions to make that scenario match as best we can what we're seeing. One more, as we get on the other side of this, is there value in continuing the cash flow planning? And I'd say 100% yes on that. The example I gave before about that company that in December had an immediate light bulb moment once they saw what was coming. They were able to navigate through the Christmas bonus issue and then up through their down season. And they actually entered this COVID crisis with that tool in place, and it has so much given them peace and confidence. It's just very fulfilling to see. It's something that our clients that use this tool have used it in several cases for years, and they keep using it. You want to throw one out there, Dan?
Yeah, I just got a question through the chat. The question was, what software might you recommend to implement the OKRs? And frankly, we've got clients that use a variety of things. Typically what we do when we work with clients is we'll build out either an Excel tool or even a simple Microsoft Word document, and it depends on how the company has their internal stuff set up. But for companies that have shared documents and there's an easy way to go in and update things, something as simple as an Excel spreadsheet works great. And then any project management tool, I know a lot of companies use like Asana or Monday.com or any of those. It's really easy to load in the objectives and key results into your project management tool. And then there's also a variety of free project management tools that are included in your Microsoft 365 subscription. So if anybody has questions on, kind of kicking those off or getting them started, let me know. I've got experience with a good number of those.
I got one. I've ordered inventory. I ordered it months ago when my sales forecast was much higher. How do I manage paying for that when I know I won't be able to sell through it? We've seen success with negotiating with factories to pay them enough to cover their costs and to partner with them saying the rest of it I'll pay for later. And oftentimes, whatever you're purchasing from a factory, a supplier, the cost might be half of that or 60% of that. And if you can cover their costs, they're okay, and they'll get it in this environment because they want you to be there on the other side. They want you to keep buying product from them. You got to be communicative. Same thing with banks. What do I do with my bank? How do I navigate this with my bank? Banks love seeing scenario planning. They love seeing that you've thought it through and you know what to do, that you're not just walking in the door saying, I'm in trouble. I need help. No, think it through, map it out, model it out so that you can show them, all right, this is where I'm at. And if this happens, I'm doing this. And if that happens, I'm doing that. Related to that is how to get your team, your employees to participate and feel good about this, as good as you can feel. Because let's face it, our teams, our employees are stressing out as much or more than you because they feel like they know even less than you do because they don't know what you're thinking. If you're the decision maker, what is your plan? Do you have a plan? And there's some companies that want to just take care of their employees and want to defer implementing bad news and difficult news, and they're just hoping everything just works out. If you take that approach too far, you're literally putting all of your employees at risk. You're putting your company at risk. If you take mitigating action now and you include all your employees in it, whether it's a 20% pay cut or a 20% cut in hours or 10% or whatever makes sense to you in the scenario that you're in, and you say, this is where we're at, we're in scenario 1, and if I get to scenario 2, we're going to have to do this, and you tell them and share what you're doing as best you can so that they know, all right, I'm going to take a hit, but the plan is I'll still have my job, and this company will still be around longer, and when we get through this, we'll have a company still, versus not knowing what you're doing or not having any plans at all.
Yeah.
May feel like you're doing the nice person.
Yeah, no, I think so as well. I think any kind of helpful content is important right now. I think also because we probably have
somebody needs
a few people's more attention these days.
I think I got him. So Chris, two things. We have a winner of, it's Jay Barrett. Correctly guessed Pink Floyd, Wish You Were Here.
Excellent. I am so happy.
So let's see, Al came in really close. Al Chin came in just a minute behind, or just a few seconds after, almost a whole minute after. We have another question. How
long did Jay Barrett take to answer that question?
Boy, it was pretty quick.
That's a true Pink Floyd fan.
Yeah, I have the timestamp was 9:08, so I'm going to guess within a few seconds. Here's a question from Jonathan. He said, "What about rent? Scenario 3 showed a 70% reduction in rent cost. How do you suggest going about achieving that?"
That's a tricky thing. Negotiating and communicating is the key, and we've heard many vendors, landlord, suppliers being receptive, bankers being receptive to open communication about what you need and what you're trying to do. So going to your landlord and saying, look, I'm struggling. I need help. Deferring rent for now would really help me out. Can we agree on something like that? Versus you just go into default. If it's that bad, you may not be even using your office. More than likely you're not. So what cost savings is a landlord incurring while no one's using their office? I mean, there's some logic to a reduction, but there's also more of a partnership spirit. I think it's about communication and showing them that you thought it through, and you're trying to be honorable and do the right thing, but you're also trying to make sure your company survives so that you can be a long-paying tenant or a tenant in their building for a long time.
Excellent. We have another question. Question comes in about what's the difference between layoffs and furloughs? Any suggestions on how to go about that? As an HR guy, I've lived through obviously both scenarios of layoffs and furloughs. Furloughs can be really useful if you really want to keep the people intact and keep those teams together. This isn't a great topic to go into here in this format, but I would recommend there is a bunch of really good information on the internet, and there are a good number of lawyers and such have written information about furloughs and layoffs. One of the key cautions is furloughing salaried people is pretty difficult. It needs to be done in 4-week increments. You can't do a 1 day a week furlough for people who are salary. For those who are hourly, you can. So just make sure you keep that in mind and be careful. And I always recommend for any of those things where you're looking at, offboarding people, if you're going to try to do something creative, please make sure you talk to your labor attorney. Chris, we've got another question. I think this one's good for you. Is there a percentage recommendation of labor add for daily COVID protection and inclusion into forecasting?
Say that again.
Is there a percentage or recommendation of labor to add for daily COVID protection and inclusion into forecasting? And T. Garrett, if you want to, I think you can unmute, maybe I just unmuted you. If you want to try to clarify that question.
Yeah, so looking you know, one thing that's going to be more expensive as we go forward is this daily COVID production of our employees. Is there a percentage out there right now that people are forecasting that's going to cost us on a daily? Is it an added hour? Is it a percentage of their base cost for us?
I don't know the answer to that. That's a good question, and I know how to get the answer to that. So if you make sure you give us your contact information, I'll get you that. I know business owners that are living through that right now. I can think of two right off the top of my head, and they've already put in place programs. So let me ask them what they've seen as far as percentage increase. That's a good question.
Okay, thanks.
Hey, Chris, question about utilizing line of credit. And the question is, should I plan on, absent other sources of credit, should I plan on drawing down my line of credit now or wait?
Well, that's an interesting question also, and I have a pretty interesting answer. One of our Vistage, I'm a member of Vistage, which is a great organization, by the way, and one of the members asked that question because they were concerned that their bank might get a little nervous and pull back their line when things get a little tighter, or what if they really need it and they go to get it and the bank's declared that they're nervous, so they're pulling the line or reducing the line. So he asked that very question, should I draw down my line now? And I asked our banker that question, and that what really surprised me is our banker said yes, draw down the line, but then they said put the money in a different bank, because if you put it in the same bank that you do the line from, they can claw that money back, claiming some, again, banks can kind of do anything when they say they're nervous about you. They could claw back that money as essentially a set-off, a right of set-off in a manner of speaking. So put it in a different bank. Now, to me, that sounds a little bit underhanded to draw it down and park it in another place, but we're talking survival here. And again, a banker told me to do that. So I would say that makes sense.
All right, got one more question. I have inventory that I ordered months ago when my sales forecast was higher. How do I manage paying for that full order when I know I'm not going to be able to sell through it all?
I think we did that. That was one of the ones I answered early on. Okay. But again, I would just say, that's negotiating with your suppliers.
Sorry. It's okay. I just want to let you know that the line is out for delivery again today, and I
think I got it. Got it. Okay. Any other questions coming in through chat? I appreciate the questions coming in. If anybody else has got one, or I know a lot of you are unmuted, feel free to fire off a question.
I think I got one more. Being several of us are small business owners, I being one also. So to the extent you are taking distributions, running personal expenses through the company, and at the same time asking your team to be participating in actions like pay cuts to help get us through this hard time, and working hard but working remotely and dealing with all the stress associated with it. I think it's really important to show that you're participating in the solution at even a greater level than your team is. So cutting back on expenses that you're running through the company, cutting back on your own pay. A really nice thing you could do for now, if you are a small business owner, is shifting your pay from payroll to distributions. You can save quite a bit in payroll taxes. It's certainly, at the very least, a deferral, but it perhaps is justifiable if you can justify that you're still getting fair market comp. You can call the rest of distributions, and in this market, what is fair market comp? I would argue that it's arguably less than it's been, and that will save you payroll taxes, maybe permanently, but at least temporarily, and that's something you can do right away.
All right, we're up on our scheduled time of 9:30. Check in to see if there are any more questions. We're happy to field them now. Also, our contact information is up there.
This is Michael Sabri.
Go ahead, Mike.
Hey, Michael, it's John Tyler, Guitar Trades.
Hey, how are you?
Oh, you took a call. So our contact info is up there. Both our cell phone numbers and our email addresses are there. So feel free to fire away with emails. We did record this call or this session, so we will get that posted up and get the link out to those of you who would like it. And any other parting questions or smart remarks before we sign off?
And we will make the PowerPoint available to you if you want it. Just let us know. We want to help you through this. If you want help, all you have to do is ask. And thank you very much for being a part of today's session.
All right. Thanks, everybody. And we'll go ahead and sign off now. Have a good day and be safe.
All right.